Welcome traders. In this video we're going to go over the trend and counter trend trade pattern that is found in ZoneTraderPro. And to start, what a counter trend trade is, it occurs when price trades at a blue zone and we are not currently trading in an exhaustion pattern. A trend trade occurs after price retraces from any blue zone. So let's take a look at what that means. A counter trend trade is going to occur at a blue zone, provided it is not an exhaustion pattern, and it is not necessarily a higher risk trade. It's just more of a lower reward trade because all we're doing is taking out the late buyers or sellers and giving the smart money a chance to get back in and resume the trend. That's the difference between a counter trend trade and an exhaustion pattern. The exhaustion pattern is actually looking for reversals and gives us a higher potential reward than does a counter trend trade. A trend trade occurs after price retraces from any blue zone. The retracement that is occurring is taking price back to the intermediate zone of support or resistance. And more reward is associated with a trend trade than with a counter trend trade. To set up a chart for a trend trade, what we're going to do is we're going to take a 150 tick chart, and on the zigzag ZTP indicator, we're going to put deviation points at 1.25, and we're going to put the deviation points at 2.5 if we are making a 500 tick chart. For the ZoneTraderPro indicator, it's a little bit different. On a 150 tick chart, we want 5 for the zigzag ticks, and on a 500 tick chart, we want 10 for the zigzag ticks. When looking at the trend and the counter trend patterns, let's take a look at why we want two charts. The larger time frame 500 tick chart removes some of the noise and provides us an exit target. We also want to use both charts to eliminate trading signals if there's additional identified risk. So let's now take a look at when we have a trend trade pattern, what are those risks? Any trade, either a trend trade pattern or a reversal trade pattern, can occur after a tick divergence or an exhaustion trade. If we are going to look to trade after a tick divergence or exhaustion trade, we're going to accept additional risk because the exhaustion and tick divergence patterns are reversal patterns, and that leads us to the additional risks. This statement may not apply to the 500 tick charts because there's not been sufficient study of the 500 tick charts to determine whether or not there has been higher risk. One thing to watch, however, is if on a 500 tick chart, any trend trade that is following a tick divergence exhaustion pattern as noted in this slide. The $ tick can also be used to justify a trend trade and reduce the risk. In the trend trade you see on this slide, we have lower tick lows and lower tick highs. One of the other risks that are associated with this pattern is if we should enter a strong trend reversal. Those areas are marked in red on this chart. The areas marked in red are basically going to inform our decision as to whether or not we should take a trade after this. And part of the reasoning here is that a failed trend trade is taking us into a strong trend, and we do not necessarily want to trade during that strong trend because of an increased risk of a trade failure. For a trend trade, what are we going to look for in a trade? Well, on a 500 tick chart, we're basically going to look for the market trading to the blue counter trend zone and then a retracement to the intermediate support or resistance zone. Next, we're going to look at a 150 tick chart for any red flags. I highlighted this trade because one such red flag did appear on the 150 tick chart. If a trade is taken, we need to be aware of what pattern is showing on the chart so that we are fully aware of what the risks are. In this case, we are in a strong trend reversal on the 150 tick chart. And what we would be concerned about is after the market started to trade down, that we could see a bounce and trade higher after about 2 points had been, in fact, because of some of the other factors you're going to see next, this trade was an excellent trade to take because of what the delta strength indicator was telling us. On a point and figure chart, what we want to see is the divergent delta strength. So if we are looking to take a short, we would want to see an up bar with a negative delta strength at the top. And you can see three such examples on this chart. The first two examples occurred at the tick divergence exhaustion trade that was good for about 6.5 points. The third divergent delta strength indicator was for the trend trade that was indicated on the chart. The last thing we want to see on the chart is order flow, and it is also nice to see that we have good delta strength there also. Order flow patterns at the point of the trade are going to be extremely helpful, especially the exhaustion and the POC extension order flow patterns. There's one other thing to note on this chart, and that is the low volume warning as price reached its apex. What that is saying is that the sellers are not actively participating, allowing the price to rise to get better prices. After making this video, I thought I needed to explain in more detail why I'd green-lighted the trend trade even though there was a red flag warning against taking that trade. When we look at the chart again, we see that we were in a strong trend reversal. And the definition of that pattern is when we trade from blue zone to blue zone. And then the trade would occur on the retracement back to the minor area of support here. That is what would be expected to complete the pattern. If we trade through minor support, then it is likely that we could trade into a broken reversal pattern, a topic that has been covered in a previous video. Part of the reason I would greenlight the trade is because of the strong delta strength and the order flow patterns that had been developed. I also knew that if we entered a strong trend pattern, I would have a clearly defined stop for the trade. That is what is the important reasons that the trade was green-lighted. In the example on the chart here, if we were to see a bounce from the area of the minor support zone, I know that my stop needs to be in this area up here so that a strong trend doesn't continue to develop and create a larger loss. Here's an example of a strong trend reversal along with a strong trend. And what I would have been worried about in the trade that we were talking about is that when we reach the minor area here, that I got a bounce back to the entry point. And that in fact didn't happen with our trade. Only a trader with ZoneTraderPro can see the filtered delta strength numbers. Only a trader with ZoneTraderPro can see the order flow patterns that are being created. And only a trader with ZoneTraderPro knows what is a defined strong trend reversal pattern. Any other trader without the ZoneTraderPro tools does not know this information. But with ZoneTraderPro, you understand that if you accept additional risk on a trade that you can justify, you understand what can go wrong and plan for it. So in this trade, I would be planning for the possibility that the market is in a strong trend and could trade higher. If it does, I have planned where my stop is. If it does, I will see it on the chart before price reaches that stop. And if it doesn't, I am in a very successful trading opportunity. I want to thank you for watching this short video on the trend and the counter trend trades. And if you should have any questions, be sure to give me a call. Thanks for watching and have a good day.